The Federal Reserve's mission is to keep the U.S. economy humming, not too hot, not too cold, but just right. When the economy booms and runs hot, distortions like inflation and asset bubbles can get out of hand, threatening economic stability. That's when the Fed steps in and raises interest rates, which helps cool down the economy and keep growth on track. Understanding interest rates. In simple explanation, interest rates determine the amount paid by borrowers for holding money from lenders. These rates are usually expressed as a percentage of an amount paid for a period of 1 year. However, they are also sometimes calculated over shorter periods. Offered interest rates vary from product to product and from bank to bank, with a number of factors contributing to the rate of interest. When investors devote capital to a financial product, the bank is in effect borrowing the money. The interest is the price paid by the bank for leaving the money with them for a fixed period of time. For example, an investment of $10,000 for 1 year with an interest rate of 2% means the investor will receive a total of $200 in interest at the end of the term. What happens when rates are raised? When the Fed raises the federal funds target rate, the goal is to increase the cost of credit throughout the economy. Higher interest rates make loans more expensive for both businesses and consumers, and everyone ends up spending more on interest payments. Those who can't or don't want to afford the higher payments postpone projects that involve financing. It simultaneously encourages people to save money to earn higher interest payments. This reduces the supply of money in circulation, which tends to lower inflation and moderate economic activity, aka cool off the economy. Take a family shopping around for a $300,000 30-year, fixed-rate mortgage. If banks were offering them an interest rate of 3.5%, the total lifetime cost of the mortgage would be approximately $485,000. With nearly $185,000 of that accounting for interest charges. Monthly payments would clock in around $1,340. Let's say the Fed had raised interest rates by 1% before the family got a loan. And the interest rate offered by banks for a $300,000 home mortgage loan rose to 4.5%. Over the 30-year life of the loan, the family would pay a total of more than $547,000, with interest charges accounting for $247,000 of that amount. Their monthly mortgage payment would be approximately $1,520. In response to this increase, the family in this example might delay purchasing a home, or opt for one that requires a smaller mortgage, to minimize the size of their monthly payment. Impact on stocks. Higher market interest rates can have a negative impact on the stock market. When Fed rate hikes make borrowing money more expensive, the cost of doing business rises for public and private companies. Over time, higher costs and less business could mean lower revenues and earnings for public firms, potentially impacting their growth rate and their stock values. More immediate is the impact Fed rate increases have on market psychology, or how investors feel about market conditions. When the FOMC announces a rate hike, traders might quickly sell off stocks and move into more defensive investments, without waiting for the long, complicated process of higher interest rates to work their way through the entire economy. Impact on bonds. Bonds are particularly sensitive to interest rate changes. When the Fed increases rates, the market prices of existing bonds immediately decline. That's because new bonds will soon be coming onto the market offering investors higher interest rate payments. To reflect the higher overall rates, existing bonds will decline in price to make their comparatively lower interest rate payments more appealing to investors. Impact on savings accounts. While higher interest rates might be bad for borrowers, they're great for anyone with a savings account. That's because the Fed funds rate is also a benchmark for deposit account annual percentage yields. When the FOMC raises rates, banks react by increasing the amount you earn from deposit accounts. That means the APYs you earn on savings accounts, checking accounts, certificates of deposit and money market accounts rises higher as well. Typically, online savings accounts react more rapidly to Fed rate changes because there is much more competition among online banks for deposits. There's a common mantra when it comes to the Fed: don't fight it. Most of the time, it means investors should adjust their decisions along with monetary policy. Consumers, however, might want to take the opposite approach. A rising rate environment makes prudent financial steps all the more important. Especially having an ample amount of cash you can turn to in an emergency or taking a long-term perspective. Boosting your credit score, paying off high-cost debt, or refinancing into a lower rate can also all create more breathing room in your budget in a rising rate environment. Use Bankrate's tools to find the best auto loan or mortgage for you. That wraps up the video. I hope you enjoyed it, and if you did, make sure to give it a thumbs up. Subscribe to our channel and don't forget to press the bell icon to stay notified about our uploads.